Okay, we are recording now, and folks will start coming into the webinar. So this is the webinar for today, the Entrepreneurs Education Collaborative, or EEC. And we have our guest today, Dr. Ernie Goss. We're going to be talking about inflation and the regional and national economic outlook. We're going to give it a couple of minutes till we get right till 11:30 Central Time, and then we'll get things going. Thanks for joining us today. For those of us who are panelists, if you're not me, why don't you go ahead and mute your line. Ernie, you can keep yourself unmuted as well.
Okay, I'm unmuted, correct?
Yep, just stay right there.
Okay.
We do appreciate you joining us today. I
Sure,
noticed
good.
we're one date off on the overview here on the screen shared slide. Today is April 20th, 2022. And if you came for the EEC session on inflation and the regional and national economic outlook, you're in the right spot. We're going to wait just a couple more minutes, and then we'll get things going. I think we've still got a few more folks coming in, as we typically do right at the bottom of the hour. So one or two more minutes, and then we'll get started with the presentation. You're in for a treat today, folks. Dr. Ernie Goss, PhD, professor of economics with the McAllister. He's the McAllister Chair Holder at Creighton University. He's going to give us an overview on the state of our economy, and what things look like, as well as the regional and national economic outlook. Well, let's get things going here today, folks. As others continue to join, we'll get started with the introductions and some of our standard housekeeping. Appreciate you joining us today. This is indeed the Entrepreneurs Education Collaborative's virtual session titled Counteracting the Effects of Inflation, a Regional and National Economic Outlook. Today is Wednesday, April 20th, 2022. My name is Blake Martin. I'm a local entrepreneur like many of you and a founding member of the Entrepreneurs Education Collaborative, or EEC. So the EEC, who hosts these sessions, is a collective effort of the following community resource providers: Better Business Bureau, Catholic Charities, the Greater Omaha Chambers Reach Initiative, the Nebraska Enterprise Fund, the Nebraska Business Development Center, OPPD, SCORE Mentors of Greater Omaha, SourceLink Nebraska, the Business Ethics Alliance, and the U.S. Small Business Administration. We'll have a quiz on that for $100 at the end of the session. You don't have to memorize all of it. Just remember, we're your one-stop shop for all things small business education around here. You might want to close out the browser tabs if you experience any bandwidth issues. We've noticed that helps. Please be aware that all participants will be muted throughout the session. We will be checking questions real time via the chat function in Zoom. So please submit any questions you have before, during, and after the presentation. We'll try to answer all of your questions today. And if you still have unanswered questions afterwards, just reach out to any of the EEC organizations that you know, and we'll make sure to get your questions covered for you. As you may already know, if you're a frequent flyer with us, we typically have these sessions posted to our Facebook page. Just Google Entrepreneurs Education Collaborative or search Entrepreneurs Education Collaborative on Facebook, and you'll see our downloadable and shareable copy of this recording as soon as tomorrow. We'll be continuing with monthly virtual Wednesdays at 11:30 through 2022. And guess what? Next month, May's session is going to be both in person and virtual. So May 18th, the third Wednesday in May, is retaining staff without breaking the bank. It's going to be in person at Access Bank, the one near 90th and Dodge, or right here on Zoom. And then June 15th, we'll have customer retention, also the third Wednesday. I want to share a couple key perspectives for today's session, which is counteracting the effects of inflation and a regional and national economic outlook, and then the introduction for our presenter. When small businesses are faced with changing economic realities, the best way to prepare is to understand what exactly to prepare for. To hear from those who study the economy and those who've seen these circumstances before. On a topic this large, we get it. We understand that every industry and every individual business has to respond in different ways. So we know we can't give you all the answers and solutions specific to each of your businesses on one webinar like this. However, today's session is about providing a deeper understanding of the current circumstances that impact all of us, learning more about what to expect in the near future, and making plans based upon the context of similar prior economic circumstances. It's not all peaches and creams today. We know that, but it is important, actionable information that you're going to get, because those who don't learn from history are doomed to repeat it. So congratulations, you're the learners today. And today's lesson is from a great teacher, Dr. Ernie Goss, PhD. Ernie, I've got to embarrass you for just 2 more minutes, and then the floor is going to be yours. Dr. Goss is the Jack McAllister Chair in Economics at the Hyder College of Business at Creighton University. He's the principal of the Goss Institute, editor of the monthly newsletter titled Economic Trends. He produces a highly sought-after monthly business conditions index for the 9-state Mid-American region, along with a survey of bank CEOs in 10 states, both of which are cited in about 100 newspapers every time. He's a former faculty research fellow at NASA's Marshall Space Flight Center. He's testified before the U.S. Congress, the Kansas legislature, and the Nebraska legislature. And he's published more than 100 research studies on economics and business. In all of his downtime, when he's not doing that, he's written and had 2 books published on the subject. If it's a business, economics, or financial publication or show that you've heard of before, Ernie's been an expert guest on it, and we are extremely appreciative to have Dr. Ernie Goss join us today. Thank you so much for being here today, Dr. Goss. The floor is yours.
Okay. Thank you, Mike. Thank you, Blake, and Michael as well, that got me, he originally made contact with me and the Entrepreneurs Education Collaborative, and I'll have to forego that $100. I can't name all the organizations, but but thanks to all of them. And you see the topic there, the national economic outlook, black swans and golden geese. Unfortunately, I'll focus more on the black swans and less on the golden geese. Black swans, of course, an event that's very unlikely, but also very costly. And you see the area I'm going to be talking primarily about, but the national as well. Those are the 10 states that we survey at Creighton University each month. And I'll talk a lot about inflation and the risk that that's posing for all of us, and to some degree how one can minimize the cost of inflation. And I'll focus less on that because it's almost very difficult unless you're willing to take the risk of investing in, for example, the commodities space, which I'm not a big fan of, but that's one way of doing it. But I'll talk more about other factors. And first, I'll talk about the challenges for 2022. Now we're 4 months in, of course, but obviously inflation, it's running at 8.5% year over year. 30-year mortgage has gone from 3% to 5.1%. And I'll apologize for this presentation here. It's a bit dated. I put it together last night. I mean, we're talking about things changing and changing dramatically and changing quickly. And take the average home in America. This is across the U.S. now, not including the increase in the prices. The increase in the mortgage rate is putting on an additional $382 per month for that average house across the U.S. And then on top of that, you've got an increase of 19% in terms of the house price itself. So one thing to do right now is at least right now, signing on and getting borrowing today, mortgage rates are not going to get cheaper. Short-term interest rates are not going to get cheaper. Now they may be on the next 2 years. I'm talking about a 2-year window here out through 2023, but in this window, rates are going higher. I'll talk about how things that you can watch out for going forward, and looking at the risk. Commercial real estate, obviously, you are entrepreneurs, you know what's going on in commercial real estate. You see me sitting here in my home office instead of my Creighton office, and a lot of us are doing that, and that's of course reduced the demand for commercial real estate. But look at Case-Shiller Home Price Index up by 19.2%. Now that's on a 10-year average of 10.2%. So I'd like to say, and if you got a pen, write this one down. The chief Herb Stein once said, he was the economic advisor to Richard Nixon in the early 70s, chief economic advisor. His son, of course, Ben Stein, you remember Bueller, that was his son. Okay, so his father, Herb, said, and this is very important, if something can't go on forever, it will stop. I mean, that's economic genius speak right there. And what that means, of course, is this is just what we're seeing now cannot continue. I'm already seeing cracks in home prices. So if you're counting on flipping houses, now's the danger. You're in the danger zone now. Watch out for it. I bought 12 houses back in the economic downturn of 2008. I turned them over. I don't manage the properties, but I have to unplug my phone. It rings off the hook, people trying to buy my houses. And that just tells you it's flaming. The housing market is flaming for houses that I own. So watch out. I would be very careful buying a house right now, unless, of course, you're buying a house to own a house and live in the house. Now, there's good reasons. If you're counting on investment purposes, watch out. I don't think that's not where I want to play right now. Supply chain disruptions. Blake didn't say, but I'll tell you, we survey at Creighton University supply chain managers and bank CEOs, 2 different surveys each month. Been doing supply chain manufacturers for it's between 25 and 30 years. I don't know the exact month. They tell us, and this is in the 9 states stretching in the north to Oklahoma, from North Dakota, Minnesota, right down the middle of the country to Oklahoma, Arkansas, and the south. And disruptions, that's very costly right now, pushing up inflationary pressures. And President Biden has said, incorrectly, that Putin's to blame. No, Putin's not. I mean, that's like blaming the rooster for the sun rising in the morning. No, they both happened at about the same time. Although the increase in the home price, increase in inflation happened well before Putin even lined up on the borders of Ukraine. This is not difficult. You do not need an economist to tell you this. What causes inflation? The Trump administration stimulus plan, the Biden administration stimulus plan, and a 40% increase in the money supply. 40%. Now the Fed's pulling back now. They're reducing to some degree the money supply, certainly no more growth in the money supply. That's going to push down inflationary pressures, but we've got more to come. And unfortunately, right now is no time to be betting against inflation. You need to bet that inflation is going to continue in the immediate and short term, and even into the intermediate term. Long term, I'm back to 2%, but right now, not the case. Federal debt. Watch out for the debt in the debt market. the before the pandemic debt, that's private and public now, private and public, 105% of GDP. It went to 135 during the pandemic, and it's going to be rising to 150%. And we've got here, I've got MMT. What is MMT? Modern monetary theory. That's neither modern nor theory. That's what I'll call political crap. We've got politicians telling you that we can continue to spend, and it doesn't cost anybody. It's free money. Alexandria Cortez says that's what she believes in. Well, she believes in what I'll call political chicanery. Doesn't work. Somebody's got to pay the price. When is it paid? We don't know. Keep an eye on the 10-year Treasury. The yield on that will tell you a lot about when this game is going to, when it's going to end. When I was a kid, we used to play this game called musical chairs. Be 5 chairs, 6 people. The music played, and then when the music stopped, you look for a seat. Well, when the music stops on the federal debt, you better find a seat, and find a seat fast. Now, when does that music stop? Again, modern monetary theory is the idea that the Federal Reserve, if nobody wants to buy the debt globally, the Federal Reserve will buy the debt. That cannot happen to any degree. Now, the Federal Reserve has done it. $9 trillion of debt they bought. So to some degree, AOC has been correct, but it cannot go on forever. And in fact, the Federal Reserve is reversing it. So that's why one of the reasons the mortgage rates are rising right now. Another one, Biden's budget is approved. That's a huge, huge risk, and it won't be approved. I posted on this, and people say, well, just ignore it. It won't be approved. How much of it is approved? $2.5 trillion in new taxes placed on entrepreneurs, and those who have increased their wealth or income through stock purchases or from your business. Part of this came from Senator Wyden in Oregon, says, let's tax this unrealized capital gain. Now, and on the entrepreneur side, tax the increase in your, in this case, book value. And you know how do you get the money to pay the tax on your book value? Well, your business is growing. You can just pay it out of that. You and I both know entrepreneurs are betting on the future, and they bet by reinvestment. And now the federal government is going to take part of that. And you say, well, what if? And they'll say, well, if it doesn't go the way we think it's going to go, you can take that loss and write it off against that gain. And you can do that over 9 years. Poppycock doesn't work. Entrepreneurs are not in the business to lose money. That's why you're an entrepreneur and I'm not. I'm an economist, and we're the exact opposite of entrepreneurs. We bet on what happened yesterday, not tomorrow, and that's the difference: entrepreneurs versus economists. And as Blake didn't say, I was with the Congressional Budget Office while I've been here at Creighton. Believe me, the CBO does not know. And the bureaucrats in Washington, D.C. do not know. And you look at the Biden, the Trump tax cut in 2000, reform, I should say, in December of 2017, the CBO said it would cut corporate tax collections. It has not. It is actually corporate tax collections are up despite the cut in the tax rate. So the tax increase that the Biden administration wishes to enact, it's not going to be approved because we have this senator named, we'll have 2 senators, Christian Sinema from Arizona and Senator Manchin from West Virginia, say no. One day Biden's going to kiss one of them, maybe both of them, or smell their hair, whatever. I don't know what he's going to do. He needs to thank goodness that this is not going to be passed, because it would be very detrimental to the U.S. economy. We've got higher pay one of the other challenges is higher pay for remaining out of work. In 2020, 60% of American households did not pay income tax. We have too few individuals pushing the wagon and too many individuals, workers in the wagon. We need to make sure that the burden is shared more clearly. Right now, the high income individuals, I mean, look at what Elon Musk just paid in California taxes and federal income taxes. They cannot pay the full burden. It will be borne by the rest of us. So we need a more sane approach to income taxes in Nebraska, in Iowa, in the region, in the US. Are we going to get it? I think we're going to get a little more sanity, but that Biden budget proposal is dead in the water. If it's not dead in the water, the economy will be dead in the water, meaning a recession. Now I'll go to my next slide and look at the federal stimulus here. This is the Federal Reserve, and Biden is correct to assign a lot of the guilty as charged to the Federal Reserve, although he didn't mention the Federal Reserve. As you see there, look at those interest rates spiking. Now, what's going on there? Spiking because of inflation, but also spiking because the Federal Reserve is indicating they're going to be selling those bonds they've been buying. They've been buying US Treasury bonds and mortgage-backed securities, 120 billion they were buying per month, 120 billion a month. Now they're indicating they're going to be allowing those bonds to mature and even selling those bonds. What that does to the money supply is reduce the money supply, increasing interest rates, and there you see it on the long end. On the short end, which the press talks about all the time, they don't talk about the other end, the long end. The short end, interest rates are rising and rising dramatically. This last week, the Federal Reserve president of the St. Louis Fed said on May the 4th, we may increase interest rates as funds rate, the short end, by 75 basis points. It's 0.75% interest. So what will happen if that did happen? It's not going to. What it would happen is the short-term interest rates, the prime interest rate will go up by 0.75% the next day, May the 5th. It's not going to happen, but we're going from 3.5, that's the prime interest rate, to 4. In other words, a 50 basis point increase is baked in. It's going to happen unless something changes dramatically between now and then. So your prime interest rate will rise on May the 5th, a 50 basis point increase, a 0.5% increase. By the end of the year, we're talking about probably another 1.5%. So where are we then? At the end of the year, we're at 2.5% on the funds rate. That's a full 2.25% increase over 2 years. So again, the advice is borrow now. What I've bought in my own portfolio, as I'm not very keen on the stock market right now with rising interest rates, but I'm buying bonds of 1 year duration simply because it's better to make 2% than to make nothing with cash. But nonetheless, you've got to look for that going forward. Now, in terms of the current situation, Creighton's surveys, look at this. Currently, the market is chiming along just fine. There's the US manufacturing index, and look at what happened here. The economy in March and April, it did fall off the table, but it rebounded dramatically because we had very quick response from the Trump administration and the Federal Reserve. Contrary to past years, they reacted quickly, they reacted correctly, and then the Biden administration continued that. The problem is it's gone on too long now. Biden has failed to pull back on spending. The Federal Reserve has failed to increase interest rates as quickly as they should. As we say, they're behind the curve, no doubt about it. They should have been raising rates beginning in November of last year. They did not. They should have, maybe as early as October. Here's Creighton Index. Look at that. Almost the same shape. By the way, 50 is growth neutral, and you see, look at Creighton's index the last month we had, and that was for March. Boy, is this a strong economy. It would be even stronger. Think about if we could find and hire qualified workers. We're talking about companies, and you're certainly among them, and even I, in my own consulting business, running into issues of finding and hiring qualified workers. If we had those workers, if we had this supply chain disruptions, by the way, those are a lot of transportation issues, trucking issues. And as you know, you may know, Walmart has decided we can't get truckers. We're going to train our own. $111,000 a year for a trucker for Walmart. And those will be long haul, probably some short haul as well. $111,000 to $120,000 a year, not bad for a trucker, but it's not bad for an economist either. Now looking at bank CEOs, this is rural areas. So if you're seeing this and you're in a rural area, the average community size is 1,300. This is across 10 states, including Nebraska and Iowa, looking very good. But the point here I'd like to emphasize is it would be even much better if we could find and hire those qualified workers, if we could get rid of some of the supply chain disruptions, that's particularly on trucking, particularly on transportation issues, getting the goods inputs in and outputs out. Very big issue right now with a lot of businesses. And you and I both know, if you here I'm in Omaha, if I take my clothes down to the dry cleaners, I have to time it to make sure they're not closed on the day. In other words, they're closing down early, not open certain days. This broadcast, Blake advised me to get earbuds so that you could hear me better. I went down to Best Buy, and unfortunately they closed at 7 p.m. Best Buy in Omaha is closing at 7 p.m. Why? Because of labor shortages. I mean, this economy, I don't even know what will be happening if we did not have these labor shortages. This economy would be doing even better. So my conclusions, and Blake and Michael advised me to please wrap up in 25 minutes, and I'm going to do that, I hope. Indicators for you to watch. Watch the Fed. This is arcane. It sounds so arcane, but it's so fundamental. It's so important, and we all ignore it. I do too as well. The Federal Reserve owns $9 trillion of U.S. Treasuries and mortgage-backed securities. When those mature, when they sell them, that has huge impacts on long-term interest rates. That's one of the reasons mortgage rates are moving up. Last week, I got caught in the bind. Lyle Brainer, who's on the Board of Governors of the Federal Reserve Open Market Committee, she's the vice chair. I should have, if I'd known what she was going to say, she came out and said, well, guys and gals out there, business people, listen up. We're going to have to be selling some of these bonds. Oh my gosh. I had just made a donation to charity. I did I transferred some stocks out of my non-taxable account to a charity. If I'd known she was going to say that, I would have done it more quickly. I got caught between the time that I could get those stocks out of that account into the charity. I lost, I think it was about $2,000 or $3,000. And for me, that's real money. Because what happened is the NASDAQ stock index took a dive. Now, why is that? It's all about arithmetic. Okay. When any business, any stock that is counting on returns out there, meaning later on, that would be Netflix, that would be to some degree Google, to those, when the increases in interest rates goes up, that punishes those companies. So what's happened is the value stocks have become much more in vogue, or much more a better investment right now. So bet on those companies that have now dividends, that have now earnings, not out there, Snowflake or whatever business you're talking about. Inflation on May the 11th, very important reading. That's going to come in probably above 9%, above 9%. We haven't seen this since 1981, I should say. And you know what happened then? A big, tall Texan named Volcker, who's head of the Federal Reserve, said, enough of this crap. I'm going to stop it. And he stopped it very fast. And he stopped the 16% interest rate, but he also stopped the economy. In other words, it's something we got to do. So what we're seeing now is the Federal Reserve, is taking a slow approach to it. Volcker took a fast approach. If inflation continues to be out of hand, the Fed's going to have to be a little more aggressive in rate hikes, which means the potential for stagflation, slower growth, recession is much higher. Right now, I'm on the side of no recession, but I'm at 40 to 50% probability of a recession. Check the employment report on May the 4th from the Bureau of Labor Statistics. That's a Friday, first Friday of the month. Very important. If that comes in a weak number, like 100, below 100,000, I don't know what we're going to do with lower job gains and higher inflation. That's risky business. Keep an eye on the 10-year Treasury. As I said, that's it does a better job than Ernie Goss can ever do of looking out there. And what's happened is it's expanded by a full percentage point in the last several months, a full percentage point. That immediately goes in, almost immediately, into mortgage rates. Keep an eye on that. It's a measure of inflation. When inflation goes up, that yield is going to have to go up. When the Chinese decide to stop lending us money, and they do lend us $1 trillion right now, we owe them $1 trillion, that will go up. ISM, that graph I showed you earlier, very important. That comes out on May the 2nd. I think those numbers are going to be down, but still positive. The manufacturing economy is doing well. The ag economy is doing well. The bankers that we survey are doing well. That comes out tomorrow, in fact, the survey of bankers. We have a full generation of individuals, and many may be on this podcast or this Zoom meeting, or you may see it recording, that have never seen high interest rates. My class of 18, 19-year-olds, I have some freshman class, they don't know what I'm talking about when we say higher interest rates. When I financed my first home in 1983, after getting out of school, I paid 10.25% interest on that mortgage. Get ready. They may be in for some shock when we see that. And it's something we haven't seen. And keep an eye on outlook, as the Federal Reserve is going to continue. It's called tapering, selling those bonds. The outlook is for short-term interest rates will rise by another 1.5%. That's after the May 4th increase. So 2% by the end of the year higher. And that's going to only put us back to neutral. That's the scary part. Only back to neutral on the funds rate, only back to neutral in terms of the short-term prime interest rate. Well, we're going to likely have to go above neutral. Growth is going to decline. I just don't see any way of getting around it. Recession, there is a potential for recession even in this year, but the higher probability is in the first half of 2023. Larry Summers, the Treasury Secretary under President Obama, he's betting on a recession in above 50%. In fact, I think I heard him say 80% in 2023. I'm not there yet. I could get there when growth continues to come down. Inflation stabilizes. Now, this one, I wish I'd changed this. It's looking like it's not going to stabilize even at 5% by the end of the year. We're looking at inflation. Now, President Biden can turn to Ukraine and Russia to support the continuation of these high inflation rates. Equity markets, we're going to see a lot more selling on rallies and buying on. We're going to see more selling on rallies replaces buying on dips. If I can say I'm heavy in cash, that'd be an exaggeration, but I've got a lot more cash than I do stocks. But nonetheless, I've been betting and holding cash, and now I'm dipping my toe in the waters in terms of 1 year out, 2 years out, getting rid of some of my cash, because cash is suffering at the tune of 9% right now, 9% year over year loss. And sports betting, Nebraska's, I don't mean to talk about Nebraska, but many of us on this Zoom are in Nebraska. We're going to have 6 casinos in Nebraska, perhaps as early as, it won't be next year, but probably the following year, we may have 6 casinos. What happens in terms of sports betting, and what happens to your business if you lose some of your customers to sports betting? What happens if you lose some of your customers to slot machines? And that means restaurants, for example, losing, hotels to a lesser degree. But anyway, entertainment venues. The Black Swan event, and you don't need me to tell you this has been on my slideshow for almost a year now. And now it's becoming more and more possible. We have to understand, I have to understand that we economists, we see actions like Putin and Xi Jinping, head of the Communist Party of China, Chinese Communist Party, is nuts. But it's not nuts from their vantage point. They don't see the world necessarily from an economic standpoint. They see it from an authoritarian standpoint. In other words, they'd rather knuckle under their population than to allow it to thrive if it gets out of hand. In this case, so they think Taiwan is out of control, out of hand, and it is. But flyovers of and I was in the Navy. I'm a military, ex-military guy, and we used to fly over looking for submarines. Well, in Bermuda, around Bermuda, though, this is going to be around the Taiwan Straits and off the coast of China. Watch out there. That would have dramatic consequences on our economy and the agricultural economy, particularly, and the economy in this part of the country. That would have some huge impacts in terms of, instead of driving up agricultural commodity prices, we would see those agricultural commodity prices coming down. And that's a fear I have. And what goes on, of course, in oil prices. And you've seen what the president's done there with releasing 1 million barrels a day from the strategic oil reserve. Even with that, we're still at above $100 a barrel in West Texas crude. So he's going to end that, or he says he's going to end in September or reevaluate in September. Very important. What happens after September when those are reevaluated? Does the president continue to release that 1 million barrels a day? I don't know. Obviously, the president does not call me when he wants to make a call. So I think I've finished right on. I'm almost on time there, Blake. If we can take any questions anyone might have, I don't know.
I have one question so far. I'm hoping there's some more coming in. Is the residential real estate valuation spike more a factor of a lack of inventory, or do you feel it's a lack of something else?
Well, that's a great question. And I asked my student that very question, and it's a bit too complex for a principles class or intro to economics. But look, is it demand or is it supply, first off? Well, when you have prices growing, which they have been, but quantities coming down, that is a supply-led price increase. It is. So it's an inventory issue. And what we're seeing, and I grew up in Atlanta, my brother does, he's a builder in Atlanta area. There's still issues of supply inventories. The builders cannot find workers. They cannot find plumbers. They can't find electricians. They're even, in some cases, now I've not seen this, taking appliances out of their own home and putting them in a house they want to sell. I mean, that's happening. It's happening. So it is a huge inventory issue of the houses, but also an inventory issue of appliances. It's just remarkable what we're seeing in the housing market, and it is, but demand is likely to come down. Supply, it's a supply-led, inventory-led price increase, but now demand is going to be coming back with higher interest rates, but also individuals being unable, because of that, being able to not afford the average house price. The average house price in America, the median house price in America, is about $380,000, $381,000. That's well above the median in the midsection of the country, but nonetheless, the median in this part of the country has grown dramatically as well. So my fear is that the demand will come down even faster than the supply perhaps increases. Again, the supply increases are dramatic. If you live in this part of the country, try finding an electrician, try finding a plumber, not easy. So that it's an inventory situation, and it will likely continue for several more months. I'm talking about months. I'm expecting this housing situation to turn around fairly quickly. Maybe by the end of the year, the housing market that was a bull market is going to become a bear market, and that's scary. You look at the price of home builders. Look what happens to the price of the stock of home builders. Has not been good, and that's investors are seeing it, and I think all of you would probably see it as well.
Great, thanks for the insights. Second question I have, and you get to use your crystal ball on this one. So if you were to get out your crystal ball, how does the economy look in 1 year, 2 years, and 3 years out?
Okay, and by the way, we're sometimes called soothsayers, economic forecast. No, it is a crystal ball, and in many cases, mine is not much better than anybody else's. But I think we're looking at very, very slow growth in 2023 with potential for a recession. Now, beyond 2023, we're looking at an economy that's going to grow. I look forward to, and I don't mean to get political here, but there are lots of, we're talking about progressives that are going to face some reelection challenges. And I'm not, they could be progressive Republicans as well as Democrats that are really, some bad things are coming out, ideas. For example, ideas like a 32-hour work week coming out of California. Now, you entrepreneurs, would you like to see your business have to pay time and a half time over 32 hours? I mean, that would have some serious implications for the U.S. economy. What starts in California, hope it stays in California. That is a bad idea. I think with the elections, and again, I think we're going to see those who reject some of these, what I will call bad policies. For example, lockdowns. We got economic lockdowns. You don't have to be an economist. Go to the CDC, get the data, put it in a spreadsheet, and I promise you, you can come up with it. You can show clearly what happened in New York compared to Florida, California compared to Florida. Lockdowns did not work, do not work, but we have some politicians that are more, they are more interested in authoritarian action, putting the clamps on the, putting a damper on us via face masks, for example. I mean, not only that, you and I both know that you're sitting in a restaurant in close contact. You don't have to wear a mask. You get in an airplane, you have to wear a mask. These diapers you're putting on don't work, do not work. Now, N95 masks do work, but the airlines do not require N95 masks. Restaurants do not require N95 masks. It's nonsense to require these ineffective cloth masks that don't work. So again, in our out longer term, I think this economy, we are in the best part of the best nation on the face of the earth. Americans are wise. The population is wise. We will have politicians following the population. The population is saying, we want to grow, we want to thrive, we want to do business, and we'll have some policies that will follow that. It won't be the policies that follow that are ahead of the people. The people are ahead of the politics, and they will tell us in November, we want growth. Now, unfortunately, 2023 is almost in the books. 2024, we're going to see the Fed probably reverse course and begin reducing rates. Now, that doesn't make any sense to you, nor should it make sense to you. I mean, this up and down Federal Reserve, Milton Friedman had the right approach. let a computer make the decision about money policy, monetary policy. A machine can do better than we economists have done. And that's very true. But I would advise you also to keep an ear to the ground, listen to what the Federal Reserve policymakers say. When yesterday, Raphael Bostic with the Atlanta Federal Reserve said he sees the neutral rate as 2.5%. Now that's very important. He's on the open, he will be I think he's a voting member of the Open Market Committee. He's head of the Federal Reserve of Atlanta. He's saying 2%. He's saying another 2% on the interest rates by the middle of 2023. That's what he's saying, or as early as the first quarter of 2023. So he's saying, so get ready for 2.5% interest rates. Now that's on the funds rate. You add that to 3%, so your prime interest rate is up to 5.5%. So that's what you're looking at for the first quarter of 2023. That will slow growth, potentially push us into a recession. Then you get the contrary to that, which is the Federal Reserve. Although again, if you unleash the energy of this economy, you'll see some growth, and good growth. I mean, good growth.
And I think you mentioned a lot of it, but there's another question: how do you counteract, the effects of inflation? And I guess a balancing act is.
Oh, but in terms of your household, okay, my spouse and I, we're getting, we have Treasury Bonds getting 9% on them. Now think about that. We're ahead of the game. Now you can only buy $10,000 for each of you. We bought 10,000 each, so 20,000 December. We bought 20,000 more in January. So I bonds is one way of doing it. And you can go on to Treasury Direct and buy those. Bonds, stay away from bonds, except those. And if you have cash, I bought this past month, I've bought some 1-year treasuries. I'm getting 2% on the bonds. I mean, for goodness sakes, you don't need to be an economist there to see the problems with that. But at least it's better. I'm earning 2% and the real return is -7 if the inflation rate's 9. So that's no way to make a fortune. It's a way to lose money, but at least I'm cutting my losses. Now, in terms of businesses, I mean, I can say more about the investment than how to run your business. I obviously, if I were like I tell my class, if I were so great at this investing and business, running a business, this Zoom would be coming to you from Hawaii. I'd be in Honolulu. I'm in Omaha, and it ain't nice out there today. So So betting on what I say is not good business, except I think on the inflation front, interest rates. But in terms of the rental market, rentals still look good. Residential rentals, I'm speaking of. I'm doing quite well in the rental market, but those are rents that those are structures that you already own. Obviously, buying a structure to rent, not a good time right now. Don't be getting into any variable loans, borrowing at variable interest rates right now. I think those will. I'd get into fixed right now. Now again, I expect rates to come down in 2024. So if you're looking at it that way, so the variables will come down. Variable will come down in 2024, but in 22 and 23, those variable interest rates are going to be going up. If I'm borrowing now. I'm not delaying my borrowing. I don't see that as a good option in terms of borrowing. And in terms of hiring, one thing that many of you, I think, miss, it's not because we in universities don't understand business people, and business people don't understand us, and that's not such a bad thing. But what I would like to see business is more interaction, more internships. So in terms of you getting employees, seek out the universities, seek out the community colleges, go there, speak. I had Matthew McKeever speak to my class last week on Bitcoin. Now, he's coming in. Now, he's not in the market for hiring workers. He's a lawyer by trade and by education as well. Matthew's a great attorney, but come into these classes. These professors don't know how to approach you, and you don't always know how to approach them. We need to see more interaction there, particularly at the community college level, where you could hire at better prices than you're going to see when you do job fairs. Job fairs right now, not good. I'll tell you a short story. I have a daughter who's intellectually challenged. She has disabilities, and she's the place she was going to, and she daily to work, has now having to close down part of the week because of inability to find employees. So what we've got to do, my wife and I, have to seek alternative care for her. So it's hitting me like it's hitting you, and it's hitting this. Is the company, the organization is Mosaic, which, by the way, is a great organization. And if you've got any charities, I'm not part of it, so, but it's a great charity. But anyway, giving to that, I'm afraid I can't be of much more assistance than what I just did. But getting employees through internships, you already know that. But how do you effectuate that? How do you make it happen? Is visiting the colleges, visiting the placement offices at universities, visit the placement office at Creighton, at UNO, at Bellevue, at Metro Community College, at Clarkson, and so on.
That's great. And moving on, we do have a double question here. So at what level will rising mortgage interest rates bring supply and demand balance to current inventory and new housing production levels? Secondarily, will we see a summer spike in inflation as the lower inflation summer months of 2021 are replaced with 2022 monthly data? And will the Fed be patient as year-over-year inflation data filters out?
Well, the answer, reverse order, the Fed won't be patient. They're going to be raising rates, and they will go too far. And that's unfortunate. Regarding inflation this summer, the individual is correct. Year-over-year comparisons get better, so inflation will moderate. Now, I think the first question was about mortgage rates. What mortgage rate will bring supply and demand to in equilibrium?
Yeah, correct.
I think we're probably talking about mortgage rates rising by as much as 3% more. That's a killer. It's going to be we're going to have an oversupply. Oversupply is hard to argue, but I think we're going to see 3%, but I think 2% increase in the mortgage rate from 5.2 to 7.2. That's going to, the demand and supply are going to come back into agreement, if you want to call it, instead of equilibrium. And it's going to go beyond that. I'm looking at, believe it or not, I don't think, we're not going to see a return of the 2008, 2009 downturn in housing, but we are going to see a very quick softening in the housing market, in my judgment, as the yield, those interest rates go from 5.2 to 6.2, maybe by the end of the year, 6.2, maybe 6.2 to 6.5, somewhere in that neighborhood. That's going to cool it off. And then 2023, you're still talking about increasing mortgage rates, because the Fed is still going to be getting rid of selling these bonds, and that it does increase interest rates. So we will have that happen. That will be a real softening. Will it be a market for me, Ernie Goss, and perhaps for you to go in and buy housing mortgages that have defaulted? No, I don't think they're going to be. It's not going to be a 2008, 2009 situation.
That's the questions I have for now, Blake. That doesn't mean
Okay.
Got them all, but if anybody has one, I think we
Well,
have.
if you want to get my newsletter, it's free and well worth the price. You can see the address there, gossandassociates.com. And because of inflation, unfortunately, I've had to double the price. So it was free. I guess it's double free now. So thanks to all of you for having me today. And I'll turn it back over to Blake. And there you go. So
Ernie, thank you. We do have one other question, and that is the all important employment report on May 6th.
yes,
What level of confidence do you have in that number?
almost zero. I mean, I have been so wrong. What is it? I forgot who said it. Never have so many been so wrong for so long. And they're talking about economists. I've been betting the market would weaken, this job market would weaken and weaken. It's been very strong. I don't have, but I just don't know. My fear, what I was indicating is my fear. If it comes under 100,000, that's going to be perceived as negative from investors, because investors watch what the forecast is and where it comes in or over or under the forecast. I expect it to come under the forecast, meaning under 100,000. I don't know what the forecast is going to be. I'm not part of that survey. So I'm concerned it'll come in below 100,000, and that's just the first tip of a market, a job market, an economy that's slowly moving to back toward zero is more of a possibility than 5. Let's just put it that way. 0 growth versus 5%. I'd be on the under on that. Over under. I'm on the underside there.
Thank you. Appreciate that. And thank you for a phenomenal overview, detailed yet even I could understand it, and for hanging on for a whole lot of Q&A. So we thank all of our audience for some outstanding questions. We realize you may think of other ones. We got into some pretty deep stuff here. So if you have other questions, just reach out to us. Remember, you can always connect with us on our Facebook page, the Entrepreneurs Education Collaborative. The contact info you can see right here. We put in the chat for Ernie Goss, our presenter. Lots of different ways to get a hold of him. I'm sorry, were you going to add something, Ernie?
Yeah, I was going to say, I appreciate that comment. And Alan Greenspan once said, when he testified before Congress, if you understood what I just said, then I must have misspoke. Well, if you didn't understand what I have said, I misspoke. You didn't. The intent was to make it accessible, and if I didn't, it's my fault, not yours. So I just want to say that.
Well, thank you. I think we'd all agree that you were very eloquent as usual.
Thank you.
And again, on our Facebook page, you'll see information about upcoming sessions. Our next session is May 18th, third Wednesday of May. So always the third Wednesday. This one, for the first time in 2 years, we're going to have in person. And that is at Access Bank, the one at 87th and Dodge. So 11:30 on May 18th. And you'll always be able to continue to join here on Zoom. So just look for the information there. You'll see it come into your email as well, but our one-stop shop is the Facebook page. You can just Google Entrepreneurs Education Collaborative. It'll bring you to that Facebook page. One other feature that we've added and put in the chat is that if you want to make sure you never miss another announcement about an EEC event, we do have opt-in for automated reminders that'll come to you. And that's the link that we just put in the chat, which we'll also post to the Facebook page. So just give you automated reminders of when one is coming up. And if you have to miss one, it'll be posted. We always record these. If you know somebody who you think should have heard this or wanted to hear this session, please share it with them. It will be posted in the next 24 to 48 hours. Go to the Facebook page. It's a shareable version, and you can send it out to folks who you think would benefit from this session. One more time before we close, we want to give a very big thank you to Dr. Ernie Goss for sharing with us today. You have so many different people pulling you in so many different directions at a time like this. We really appreciate you volunteering your time. Highly valuable to everybody here. So we look forward to seeing all of you again on May 18th, either in person or on Zoom, and we hope you all have a wonderful day. Thanks so much for joining us.